Hello everyone, this is Adil Rizvi. I welcome you all for the webinar tonight. Apologies for a bit of a delay. We had some technical issues to sort out which have been sorted now. So I welcome you to our weekly webinar today on 25th of February. And today's topic is extremely interesting and very close to my heart, where people keep asking, how can I pay off my home loan faster? How can I pay the mortgage of my home loan, which is essentially the biggest bill on your account. And you need to understand, people want to really know how they can pay that off really fast and in short amount of time, because a lot of people don't want to be spending 30 years paying that home loan off. So that's exactly what we will be talking about today, guys. And if you're joining us live or if you're watching the recording, please let us know your presence. Please hit the like button. Please share it with people, because every one of us pretty much has a mortgage right now or will have a mortgage at some point of time. So definitely I'm very much sure that this will help you think in the right direction, in the direction that actually things will work out for you. So again, there's no right or wrong. This may or may not apply to you, but I wanted to share this one story of a client who comes from very humble background, very hardworking family, and how they've actually achieved and how they are on their way actually to pay off their home loan actually much earlier than 30 years. And that in their case, they can pretty much pay it off in 10 years only. So we'll go through all those details today. If you're joining us live or watching later on YouTube or LinkedIn or Facebook, please leave us a thumbs up. Let us know that you are here. Share your feedback, ask questions. We are more than happy to answer your questions, because that's exactly why we are having these sessions. So without any further delay, I'll quickly share my screen with you. If you want to have a discussion where you want to go through your personal situation and you want to discuss your personal circumstances privately, and of course keeping things confidential, then here's the QR code. You can book in a call directly with myself, and we can go through your property goals, your property dreams, and see how things can really work given your circumstances, given your income, and given your situation. So more than happy to connect with you and chat to you one-on-one as well. So here's the QR code. Beautiful. Thanks very much, Margaret, for joining in today. Your support is always very much appreciated. So guys, let's get rolling quickly, and I would like to just quickly start as always with a quick disclaimer. So anything that we talk about today in the webinar is purely generic in nature. We don't take into account your personal situation. So the information that we are presenting today or the scenario we are discussing may or may not apply to you. Therefore, please don't consider it as a financial, legal, or any kind of tax advice. Make sure you seek your independent professional advice before you try to act on any of the information that we are discussing or presenting in today's webinar. So with that disclaimer, guys, we'll quickly delve into the question that we all have. Yes, we all have a mortgage in Australia. Even if we don't have a mortgage by now, we all want to have that family home. We all want to buy a family home. There's no harm in thinking that way, and we all deserve to have a family home. That's the right for everyone. So, but what's wrong with home loan? I mean, why do we want to pay it faster? Why do we want to not pay it in 30 years? What's the benefits of paying it faster, right? And if you remember the topic is we are paying home loan faster without doing those extra repayments. Now, a lot of people, I want to bust that myth right now. A lot of people think if I make an extra $100, $200 every week, extra $500 a week, it will help me pay my home loan faster. Yes, it does. It does definitely help you. But on the other hand, it also impacts your lifestyle. It impacts how you can spend money on the other stuff with your family, with your kids, with your travel, with your holiday, with kids' education, with your insurances, your health insurance and things like that. So it's not always possible for people to actually fork out that extra $200, $500, $1,000 a week or a month to actually pay the home loan faster. So there's a different strategy we are discussing here today, and it may or may not apply to you. But again, I want to discuss this scenario with you for a very good friend of mine now and a good client as well. And the biggest advantage as to why you want to pay your home loan faster is about making sure that you save tens and thousands of dollars on interest. And I will give you a very quick example of that as well in our scenario. The other thing is your home loan that you're paying. Yes, you're paying your principal back plus you're paying interest on top of it. That interest repayments that you are doing, they are not tax deductible because you're living in your own home. It's a principal place of residence. So any tax that you pay on your mortgage repayments every single month, that tax that you are paying to the bank, to the lender, that is not tax deductible, which means you don't get any tax benefit out of it. So it's the good thing is you want to minimize on that tax, because the faster you can pay off your home loan, the less tax is actually what you pay on your home loan, right? And apparently when usually Australians are in a position to buy their family home when they're 30, 35. That's kind of the age which we see around us where people are kind of ready to buy their family home. Some people are not even ready to buy at that point of time just because of the prices have gone so high. So let's say if someone is buying a family home when they're 30 as an assumption, and if they have to pay their family, they have to pay off their mortgage on their family home for the next 30 years. So from 30 up until they turn 60, they will be paying mortgage on their home loan, which essentially means by the time they have paid their mortgage, when they've turned 60 or they're close to 60, even if they made some extra repayments, let's say instead of 60, they paid their home loan off by 55. But even at the age of 55, essentially you are very close to retirement. And yes, you have an asset which will be probably around $2, $3, $4, $5 million by that time or even more, but you can't really enjoy that asset because essentially you don't have much income left in your working year, so you will be retiring in the next 5 to 10 years. And essentially what you do then with that house, you can't enjoy it. So what people actually do is, before they retire, they actually sell that house. So they use their entire good working years when they were really young and they were working hard, they were making good money. They used all those years, those 30 years, to actually pay for a home loan, which essentially the home, when it's completely theirs after 30 years of mortgage payments, they have the home now, but they now have to sell it because they are about to downsize and they need money for retirement as well, because guess what? Your super will not last much longer. Your super is not enough. So that's where the problem happens, and that's where people, even though they have a home which is like worth millions of dollars, but essentially they can't really enjoy it. So that's the biggest problem. We want to make sure that we can pay off the home loan faster when we are still in our 40s. When we are still in our early 50s, not when we have touched our 60s or close to being 70. We don't want to drag our home loan so far away because that impacts our lifestyle. So I just want to quickly dive into this client scenario. And so this is a client actually who bought their first home. They bought it themselves. They did not buy it through us. They bought it themselves in Southwest Sydney, in Rivesby area. They bought it back in 2018, so 7 years ago. And they bought it for $862,000. Yes, you could buy homes at that point of time. It was a smaller block, relatively smaller, maybe around 400 square meter block. It sounds a bit bigger considering what lot sizes we have now in Sydney. But this was quite a decent block size considering today's sizes. But that is what they bought. They only paid 5% deposit. So just to give you a quick background, John and Sasha, again, these are their earliest names, not their real names because of their privacy. And they are like a carpenter and a customer sales rep in Coles. So both husband and wife working really hard, couple of kids. They had no kid at that time, but they have 2 kids now. So at that point of time, they were 32 and 33 when they bought this property, saved a 5% deposit, and essentially they had a loan of $819,000 on that purchase of $862,000. So they had that loan of $819,000, and like any other Australian, they wanted to pay that home loan faster. Now, the challenge they had was that at that time the interest rate was 3.2%. So to pay that $819,000 loan, they would have ended up paying around $456,000 only in their interest repayments. That was based on 3.2% interest rate back in 2018. If we assume the interest rate which is today, which is around 6.2%, they would have actually paid $986,000 only in interest repayments. So the actual loan is $819,000, but their interest repayments or the interest amount would have been actually larger than the loan amount. So that's what we want to really save on. We want to save on that $986,000, which people will have to pay today if they have a loan of $819,000 or $820,000. So the problem was they were essentially paying, they were not getting any tax benefit, as I already told you about, but they were also spending anywhere up to 40, in some cases even 40% of their incomes to actually pay off the mortgage until 2048. That was 30 years until the time that they purchased the property. So they purchased in 2018. By the time it comes 2048, they would have paid off their home loan. But during that time, they would have actually be 62 and 63 in their age, very close to retirement, and essentially all their savings, all their salary, or major part of their salary was actually going to pay off that home loan. So they did not want to do that, because at that particular age of when you're in your 60s, if you have a paid off home loan, not much income to show for, what do you use that home for? There's not much you can do with it, right? So they wanted to actually fast track their repayments, and that is when they came to us, and that's when they met us. So we created a strategy for them, and we said, okay, let's use property investing to pay your home loan in 15 to 20 years instead of 30 long years. The plan was for 15 to 20 years, but as I will show you in the numbers, they are very much on track to pay off their home loan within 10 years time. Yes, that is what they've been able to achieve, and I mean, they've done amazingly well, and this is how they've done it. So they bought their first investment in 2020. Remember, the rates were really low at the time of COVID, so it was easier to get the loan, and I will just keep relating it with our current scenario today. So they bought a house in Adelaide in Barrafield Gardens. That house was for $408,000. They did not use any cash for the deposit. So an important thing for you to remember over here is they used the equity in their RSP property because they already had that for 2 years. So they bought in 2018. In 2020, they recycled that equity. They took $80,000 out of it, and they used it as a deposit and to pay for stamp duty for this first investment. What it meant was that today, that property which they initially purchased for $408,000 4.5 years ago, that property is currently sitting at $720,000, $725,000 today. And it has gone through a growth of more than 300K as a conservative estimate, as you can see over here. Now, the important thing for you to note over here is, that is why I really want to emphasize on this. And again, this is not a financial advice, but in that case, yes, their home loan, the original home loan from $819, that actually went down slightly. That went down to $806,000 because they were paying a bit of principal amount. But that investment property for $408,000, that loan is still sitting there. So they have not gone out and tried to pay down their investment property loan. They took initial loan of $80,000 from their home. They used that $80,000 to pay stamp duty and deposit and their conveyancing fee, and even our fee as well, and use that deposit to buy an investment which was worth $408,000. Now that $408,000 loan is still there. So if you see on this screen, this is showing you the total loan amount. So their total loan amount, the only loan they are paying off is the principal home, the RSP property. So the current loan after this purchase at that time was 1.214 million. Not the current loan, but the loan at that point of time in 2020. So now keep a close eye on this, that they are not paying off their investment loan, they are just maintaining it, because all the interest they are paying on this investment loan essentially is tax deductible. So they are only paying the amount that they need to pay to hold on to the property. They are not paying any principal against this Adelaide property. So that they are saving their principal, and I will show you why. Now moving on to the next one, the second purchase they did next year in Brisbane. This time we went back and we refinanced their RSP property once again, and we took out $90,000. So for the first investment, we took out deposit from their own owner-occupier home, which was $80,000, which was additional loan. And now we have done the same again. We have actually increased the loan. So if you don't like the loan, then this is not really for you. But without taking loan and without leveraging the bank's money, you can't really accelerate your property wealth journey. It's just not possible. So they recycled the equity on their RSP property. Once again, they took $90,000 cash out, so the loan increased by 90 grand. They bought a property in Loganlea for $521,000. That property in the last 3.5 years has given them more than 300K of equity. So the growth has been more than 300K. Now that property is cash flow neutral right now. The Adelaide property is cash flow positive because they've been holding it for a while. Now, if you look at the loan after the second purchase, yes, the initial loan was around $819, so they were paying that off slowly. So in the last 3 years since they bought their first owner-occupier home, their loan has gone down to $798 because they're slowly paying it off. But Their investment loan for the first property, $408,000, that's still sitting there. And for the second property, $521,000, should be 21, not 22. That loan is still sitting there because they're not paying any principal on that. They're just paying the interest on that. It's an interest-only repayment because that works for them very well. They're preserving their cash flow. And because of that, now their overall loan, which was after the first purchase, it was 1.2 million. Now that loan is sitting at 1.7 million. And you may argue with me that they are increasing their loan unnecessarily, but please stick with me for a minute because I will show you the big impact that this will have now. Fast forward 2 years in 2023, now the first property they bought in Adelaide, the first investment back in 2020. Now that has grown to a point where now they are ready to refinance that property. So every investment that these clients have bought, they haven't used any deposit or any cash from their pocket. For the first two investments, they used their home, they're refinancing. For the third investment, they're now refinancing their first investment. And they're taking out loan from there, which was $85,000. We helped them buy a property in Bunbury for $372,000, a very well-desired area in Western Australia. It's a regional town, 1.5 hour drive, 1.5 hours south as well from Perth CBD. And that property has done really well from 372K. It is now sitting at like 550K plus in the last 2 years only. Now, going back to the loan, yes, the client is paying their principal loan slowly. They've gone down to 782, but their 3 investment property loans are still pretty much intact, and they're keeping them as is. They're just getting tax advantages on that. Their total loan sits at 2.08 million. And why they've been doing, now let me show you the summary over here. This is the real powerful slide, and I want to spend a couple of minutes on this one. So as of 2025, as of today, their original loan for the owner-occupier home or their family home in Riversby, which started, I'm just going back quickly to show you, which started with a loan of $819,000. If you can have a look over here, that loan has been paid off slightly in the last 7 years. They've been slowly paying it off because it's owner-occupier. And from 819, that loan is now sitting at $761,000. If you see my cursor over here in red. So that loan is still there. And the target was at the beginning of this chat that we have to pay this home loan faster. These 3 investments that they've been buying, if you see the last column, all these 3 investments have grown remarkably well because they've been bought in good areas. We have helped them buy in good locations, and their overall growth sits around 700K right now. So this 700K, if they want to pay this home loan off in the next 5 years, if we consider the projected growth, now property prices continue to rise in Australia. The average growth is between 6 and 7%. But in our case, we have done our estimation based on very conservative numbers of 5% only. Now, these properties have done remarkably well in the last 3, 4, 5 years since they've been buying them. You can see the last column, you can see the 3 green numbers. They are all growth. So that's all the growth they have made. But if they just keep holding on to those assets, which are all cash flow neutral, or the first one is cash flow positive. If they keep holding those assets, the good thing is that by 2030, if you check my slide over here, that by 2030, their growth of investment properties would be around $1.3, $1.4 million, if you can see my cursor. What that essentially means is, it simply means that they will have made growth of 1.3 million only on their investments by 2030 just by holding on to these assets. And because the rents are going up, because the interest rates will be coming down, they will become more cash flow positive as well. So essentially by 2030, the client will be in a position where they can sell all of these 3 investment properties, pay all the capital gains tax, because I know you must be thinking about capital gains tax. It gets talked a lot. Yes, we have to pay capital gains tax. And you can save on capital gains if you have a proper trust structure as well. That's where you consult your accountants, and you need to involve your accountant from day one. I think one learning that this client had as well, that they should have included their accountant from day one. They only started buying under the trust structure from their 3rd investment onwards, not for the first 2 investments. So essentially what they can do is that in 5 years from now, by 2030, they can just sell all these 3 investments. They will have at least 1.3, 1.4 million of equity. Use that equity, pay capital gains tax, which will be like 50% of that amount will be used towards their marginal tax rate. So whatever capital gains tax they will have to pay, it will be probably 200, 300K, maybe more. based on what their income is at the time. After paying that, they will still have to pay a loan of 761K only, which is their current loan as of today for their own home loan. So if you see, that was the home loan they wanted to pay off. So they will have enough money in 5 years' time that if they sell their investments, pay the capital gains tax, and they will still have 700K or 800K to pay off the home loan completely and have a property which will be fully paid off within 10 years. Remember, they started investing journey in 2020, and they will have their property fully paid off by 2030. Now, the reason I suggest that it may be a bit tight for you, quick tips. When these guys started, the interest rates were really low. They bought their first investment when the interest rates were around 2.2, 2.3%. Today, the interest rate is 6.2%. Yes, RBI has dropped the rate last week. It has gone down by 25 basis points. We may have few more rate drops coming forward, but I would still suggest you have to err on the side of caution. We still may not have rate reductions as we may be imagining. So for you, it may not take 10 years. It may take a bit longer. But if you follow this strategy, if you buy in the right locations, if you buy the right assets, you can fast track your home loan mortgage payment from 30 years. You can definitely bring it down to 15 to 20 years. These clients have done it in 10 years. They are well set to do it in 10 years just by holding on to the right assets. They haven't done anything. They haven't renovated them. They haven't done anything. They've just bought the right assets in the right location, which are renting out consistently and also growing in value consistently. This is what you can do as well. You'll probably require a bit longer, maybe 15 years, maybe up to 20 years, but you can still save at least 10 years by paying your home mortgage. Instead of 30 years, you can still pay it in 15 or 20 years. So guys, that is what I wanted to share with you. And I knew the session would be a bit longer today, which it has been. So we don't have time for deal of the week this week, but we'll share the deal of the week next week. And if you have any questions, if you have any feedback, if you want to get in touch with me, here's the QR code. Book in a call, get in touch, ask questions, get clarity, and please take action. Without action, you won't go anywhere. Until next week, keep safe, and I'll see you next week. Thank you.